Diversifying your crypto portfolio is one of the most important steps to actually take as a crypto investor. So I know a lot of you guys will be new to this concept and therefore you don't understand what it means to actually diversify your crypto portfolio. But not to worry, in this lecture, I'm going to be going every single step on how to diversify your crypto portfolio to actually maximize your profits and minimize the losses. Now, apparently, diversifying your crypto portfolio just simply means spreading your investments across multiple coins, tokens, or projects. Now, you might have heard of the saying, don't put all your eggs in one basket. Yeah, that is very, very important, especially when you're making a financial decision, especially an investment. Now, investing in a single cryptocurrency can be risky. Even if it's a high performing crypto like Bitcoin and Ethereum and others, it is very risky to actually put all your investment funds in one and expect it to actually give you returns. Yes, you might have all the backings, and yes, it might give you returns, but it is actually not that safe. It is very risky because now, if you actually spread your investments across five crypto assets instead of one, in case we are having in case the market decides to change and we have two declining in value, at least you can have three still appreciating in value, and then you can see that you're not going to be losing totally. You might be losing a certain percentage, but at least you will be gaining a certain percentage because all cryptocurrencies they move different, like except when there's a general bull run or bear run. All cryptocurrencies are from different companies, so they move differently. So instead of putting all your assets, all your eggs in one basket, it's rather very wise to spread them across different, so you can actually maximize. First of all, you can actually maximize your returns on your investment. That's one. And then you can actually minimize the risk. Instead of, if maybe you put all your money in one crypto asset and it declines in value, you're losing all that money. But when you spread it across five crypto assets, and then you and let's imagine three declines in value, you still have two appreciating in value. At least you're going to be gaining your capital back, and the maximum that you can actually get to is that you won't make any returns and you won't actually lose any money. You'll be at a case of break even. Now, I know some of you guys will be asking, I just have $1,000, I just have $5,000, I don't have $1 million to actually spread across crypto assets. Now, not to worry, I'm going to be showing you guys how to actually diversify your crypto portfolio, even if you have just $1,000. Now, the rule of thumb here, actually, the main rule of thumb is actually an 80-20 rule, which says put 80% in low performing crypto assets and put 20% in high performing crypto assets. But I don't see that working for me, so I have my own rule of thumb and I'm going to be sharing it with you guys now. Now, my rule of thumb is to follow the 40-40-20 rule, which involves 40% going to lower performing crypto assets and 20% going into higher performing crypto assets. Now, I'm going to be explaining to you guys why they said put 80% in lower and put 20% in higher crypto assets, and why I'm putting 40% in lower crypto assets and 20% into higher. Now, like let's imagine from the 1 to 10 scale, we have the high performing crypto assets. We have the Bitcoin, Ethereum, the BNB, the Litecoin, Solana. Now, 1 to 4, we have those heavy crypto assets, the highest performing ones. They are at the top of the list. Then coming lower than it, we have from the number 5, we have the Solana, Cardano, Algo. Coming down, they are the low. Not that they are not high performing assets, they are high performing assets, but they are lower according to volatility. Now, the Bitcoin and the Ethereum are the big boys in the market. They are actually very, very volatile. So when you put 40%, now some of you guys may be asking, why not put more money into the highly volatile ones so that you can actually make more money? Now, this is not a gambling scheme. This is not a get rich quick scheme. It's for you to get returns over on your investment over time. Now, due to the volatility, 20% in a high volatile crypto asset and 40% in a lower performing crypto asset are basically going to generate the same amount or slightly the same amount in returns. Yeah, 40% in the lower crypto assets you put it because the volatility is much lower than the higher volatility crypto asset. That's why you put 20% there. Now, instead of putting 80-20, you have put 20-40-20, and then you have 60. In case you're asking what of the other 40, I will say keep the other 40 in stable crypto assets just in case you find an opportunity to actually invest in. Now, they're not going to be saying this to you, but keep 40% always stable just in case you find an opportunity. Now, you might have put in 80%, put in 20%, and then you find a golden opportunity to actually invest in, but you don't have any more investment funds. It's going to be devastating. So always keep 40% stable in case you find an opportunity. Now I'm going to be giving you guys a graphic presentation right here. So apparently, let's say I have $100,000. I want to actually invest $100,000. Let me show you guys what I actually mean. First of all, I'm going to be taking 40% of that money. The first thing you should do is to take 40% out and invest in stable coins. Now we have stable coins like the Tether, USDT, and the BUSD, which are stable coins. Yeah, equals to $1. Now, 40% of my $100,000 is $40,000, and once I invest them in stable coin, in the next 2, 3, 4, 5 years, they are still worth $40,000. It's not changing. The value is always constant. Now, I'm going to be taking out $20,000 and investing in the high performing crypto, like you see over here, which is the Bitcoin, BNB, and Ethereum. And then I'm taking the last $40,000 and investing in Solana and Cardano. Now, one thing this is going to do actually is when the market is actually appreciating due to the high volatility of this, if I'm getting 100% from this, I just need a 50% from this to actually match these guys. Sorry, if I'm getting 100% from this, sorry, if I'm getting 100% from this lower performing crypto assets, I just need 50% gain from this to actually match this. So now if the market pushes up plus 100%, this just has to push up plus 50% to give me my profit. Now I put in $40,000 here. If it pushes up 100%, it's going to be giving me extra $40,000, making it $80,000. And then I put in $20,000 here. If it gives me 50%, it's going to give me another $20,000. This is according to your own. This is going to be giving me, if it pushes off 50%, it's going to be giving me 40 to $80,000 because the leverage used on this is going to be higher than the leverage used on this. Now if you're actually short-term investing trading, you understand that the leverage on the higher performing crypto assets are much more higher than the leverage on the lower performing crypto assets down the scale. So apparently you can actually get more with less right here, but you actually have to get more with more over here. Now, in case you're asking, what if I have $1,000? Then okay, if you have $1,000, let's actually go over this and let's go over this if you have $1,000. Okay, sorry. Now let's imagine you have $1,000 over here. Let me put this here. Or let's just use this whole. Now your overall profit is $1,000. Pardon my writing. You have $1,000. Now, like I said, the first thing you have to actually do is to take out 40%, which is you're gonna be putting in $400 right here. I don't know why this thing is clearing off. Gonna be putting in $400 right here. I want it to stick. Now, $400 right here is stable. In the next 1, 2, 3, 4, 5 years, $400 will still be $400 right here. Then when you go over to put in $200 right here, now $200 over here, you can use a leverage of up to should I say 100%. Yeah, you can use a leverage up to 100%. So just now the leverage for this is about, for Bitcoin the leverage is 125%. The leverage on Bitcoin. You're going to be seeing all this on the crypto platform. For Ethereum, the leverage is 100%. That is the leverage on Ethereum. And on BNB, the leverage is about 80%. Yes, 80%. So you should know that should be like times 100 times 10. This should give you about times 8. Yeah, this should give you times 8. This should give you times 12.5. Now over here, the leverage for Solana is 35%. Now you can see why you actually need to put more into the lower performing crypto assets to actually match up to the expectations of this high performing crypto asset. Once you put more into this crypto asset, then it matches up to the expectation of this higher performing crypto asset. Now the multiplier and the leverage for this guy for Cardano is 25%. So you see why you need more. Then obviously, if this is bringing in profits, the profits brought by this lower performing crypto assets are going to be equal to the profits brought in by this high performing crypto assets, even if you put more here, because we have the leverage becoming higher, the multipliers becoming higher, the leverage here is higher, so you can actually get more with less over here, and you can actually get less with, you can actually get more. Sorry, I think I interchanged that. I said you can actually get more with less, oh shit, you can actually get more with less over here, and then you can get more with more, and it apparently is going to be the same thing. Obviously it's going to be the same thing that you're going to be having right there. So guys, I hope you guys actually understood. And apparently, if you have $100, if you have $100, I don't think you should actually start looking to start investing. You should have a substantial amount, like $1,000. $1,000 is actually proper for investing actually. And now this is the rule of thumb, like I told you guys: 40, 40, 20. 40 being stable, 40 being into lower performing crypto asset because of their volatility and their leverage is much lower, so they need more to actually provide more significant returns. 20 into high performing crypto assets so that they can actually um, give you more because their leverage